going to look at the tangible asset. A tangible asset, remember, the asset that you can be able to touch. Here we are going to first ensure that at the end of this lesson we are able to differentiate between depreciation, cost method, diminishing balance method, and also able to prepare the ledger account. And then equipment or a vehicle, accumulated depreciation on equipment or on vehicle, a depreciation account as well as asset disposal. A tangible asset. It is important to remember that the asset register as a ledger account for equipment and vehicle show the history, cost of all the assets owned by the business. A separate record must be kept of each individual asset, showing details of the asset such as the cost price of that asset, depreciation of that asset each year, and as well as accumulated depreciation of that asset at the end of each year. It must be kept up to date and then checked against actual physical asset on hand at least once a year. When an asset is sold, details of this asset are entered in the asset register, which is a date on that asset register, must be there. To whom that asset will be sold, it must indicate that there. A selling price, and as well as the profit or loss of the asset that has been disposed by the business. All these details must be declared to SARS for tax purposes. So it is important, people, to understand this. Within the business, as we have assets which are tangible assets, there must be an asset register where we record everything about an asset that is on hand within the business before the asset has been disposed from the business. The old asset, these assets have been in the firm a position for about 12 months or more, and therefore must be depreciated for the full year. New asset, the one that has been purchased, these assets have not been in the firm or in the business position for 12 months, so that it is there not more than 12 months. So if we're talking about the asset that is within the business, we must ensure that they have been bought, that asset that has been bought during the current year, they are depreciated for the number of months from the date of purchase to the end of the financial year. If the asset is within the business, is not within the business for more than 12 months or for a year or for about 12 months, it must be depreciated on the number of months that is there within the business. If it is there for about 12 months, when we are calculating the way it depreciated, you must times by 6/12, because in 12 months it was there for 12 months, because most of the time, not even most of the time, when we are asked or we are given the information, the depreciation rate for the depreciation for about a year for per annum. So you must also ensure that you take that into consideration, that that asset was there for 6 months or 5 months. You must always times 6/12 before you calculate the rent percentage on that item, or after you've calculated the rent percentage of that item. A carrying value. The carrying value or a book value of an asset. A carrying value or a book value of an asset. So, number one, how it is calculated, find the cost price in the asset account or the asset register, and then find the total of depreciation written off which is known as accumulated depreciation, where the asset depreciated and accumulated. The depreciation of an asset has been accumulated. Account, and then in the asset register. And then you said you add and subtract. And then you subtract for you to get a carrying value. You must say the cost price minus the accumulated depreciation. You must say the first one, the cost price. The second one is accumulated depreciation minus the accumulated depreciation, and you are going to get the carrying value. So that is a format for calculating the carrying value. If let's say we are required to calculate the carrying value, you must say the cost price minus the accumulated depreciation. We are going to get the carrying value of the book value of the particular asset. GAAP principle. Remember, there are GAAP principle that also links to the tangible asset. Going concern, it's also linked to a tangible asset. The value of an asset in the balance sheet is the reasonable value of an asset, and it still is used in a business. And then this asset is still used in a business, which will continue for the foreseeable future, not the actual amount it could be sold for. So that is going concern. The asset was purchased by 50,000, for example. It's always be valued at 50,000 until it's been sold, because it keeps on depreciating. So the value for the asset that's been purchased with will not be the same as the value of an asset that will be that we can be able to sell the asset with. So, but because of the going concern, it must always be shown this asset with the previous value. So, which also has to do with also a going concern. Oh, this asset was purchased with 50,000, but it's always be valued at 50,000. That also affects a going concern as well. So, matching concept. How the matching concept linked with the tangible asset? Remember, we all know that the main GAAP principle, as we did in grade 10 and curriculum, that's linked with tangible asset is historical cost principle. But these other principles also have a relationship when it's come to this so-called the prices of tangible asset. Matching principle. How the matching principle linked with the tangible asset? If an asset has only been used for 6 months, it will be depreciated for only 6 months, as it will only have contributed only 6 months earnings. So that is matching principle. So when we are matching the number of days or the number of months that the business was with us compared to the rates it's supposed to depreciate. That's what the matching principle occurs when it's come to a tangible asset. Prudence principle or concept. How does it also link with the tangible asset? Asset with the exception of land and building will depreciate. We will depreciate tangible asset as they lose value because of a normal wear and tear. Although land and building usually increase, which means it appreciate. It value appreciate, not usually depreciate. It usually increase its value. The profit will not be entered in the books until it is released or until they are actually sold. So that is which means it always be valued at a lower price. That is a prudent principle. It must always be valued at a lower price, as although the land and building value could always accumulate, as it not depreciate. So it must always be valued at a lower price, the price when the land and building were purchased with. Even though as it increases its value, you are going to show that at the end where we sell an item. That's how we link the tangible asset with the prudence concept. So historical, the main concept for tangible asset is historical cost principle. we said all assets are valued at their original cost price. All assets are entered in the books at the original cost price, as this can be provided and then is not depend on the annual value, which also means that all assets must always be valued at their original cost price. That is a historical cost principle. It's linked with tangible asset. As we write them there, even though it's old, but you always value asset at the original cost price. You have a calculator, or let's say you have a car, but your car now is too old, but you always value your asset at the original cost price where you purchased the asset with. You have a computer, but your computer does not have, the keyboard of your computer is no longer working, but you always value that keyboard of yours at the original cost price. You have a computer that costs 5,000 if you've purchased with 5,000. So that is historical cost principle. So materiality, a tangible asset. How do you link the tangible asset with materiality? Tangible assets are items used by the business for longer than 12 months. And then, however, if the business buy a stapler for the accountant costing 150, it will last him forever. It will not be considered as an asset as this cost too small to warrant a page in the asset register. So this is materiality, where other things are written separately, are categorized separately. This item lasts long period of time, a stapler, because it costs small amount. According to materiality, it must be put separately as at least as a stationery, even though it lasts for a long period of time, because it has a small amount. It won't be able to fit the details of it on the asset register. The consistency. This is another GAAP principle that you need to also take into account. For example, consistency. Once it has been decided, once a certain percentage or for depreciation has been decided, or a certain method for depreciation has been decided, we must be consistent toward that method. Once it has been decided to depreciate a computer by 25% per annum on the cost price, which is a method, a straight line method, the same method must be used every year. We must be consistent in terms of the way we depreciate our asset. We cannot be able to change from cost to depreciation method. No, we must be consistent. If our equipment depreciate or lose its value using a straight line method, which is also known as a cost, at 25% per annum, we need to be consistent throughout the year. Use that method, which is a straight line, and then the rate percentage must also be the same, 25%. That is consistency linked with the tangible asset in terms of GAAP principles. Now let us look to asset disposal. Remember, on the tangible asset, the most part, the important part that you must ensure that you take into consideration how the asset, how to dispose an asset and how the asset disposal has been recorded. We've done this in grade 11. It's a repetition for grade 11, the asset disposal, and the tangible asset is a repetition for grade 10. So let us look at the asset disposal. So remember, when an asset is sold, there are 5 entries to be made. Remember, DCASP, and theme of asset disposal. D stands for depreciation, is updated by calculating the number of months we have had the asset since the last time it was depreciated up to the end of the year. The same cost price of an asset being sold, it transferred from the equipment or a vehicle account to the asset disposal. A, accumulated depreciation of that asset. All the depreciation from the date bought to the end or to the date sold, the transferred to asset disposal also need to be transferred to the asset disposal. That is A. As a selling price now, the selling price is entered in the asset disposal. As well, if we dispose it by cash, if there's a cash sale, debtors control if it was disposed on credit, a credit sale. Creditors control if it was disposed as a trade-in when it was traded in. Others still remember what is meant by trading in, others maybe forgot. To trade in is where you take an old asset, give it to your suppliers, so that the value of that old asset will reduce the amount that you are going to pay your suppliers. We call that trading in an asset. By drones, it can be disposed by drones, the selling price of that item that's been taken by owner for personal use. By donation, sometimes you can donate an asset. So it must show the selling price of the asset that was donated. That is for selling price. And P, the last one, P. P for profit or loss on sale of an asset is calculated by closing the asset disposal account if profit balance figure will be on the debit side, or if loss. If it's on the debit side, or if loss, the figure will be on the credit side. So you must know that there will be a profit if the balance figure is on the debit side of your asset disposal. If the balance figure is on the credit side of the asset disposal, that means that asset is disposed at a loss. What is to dispose, people? To dispose, it's when an asset has been removed from the books of the business. It's when you get rid of an asset. There are different ways where the asset can be disposed. There are examples: by selling an asset on cash or on credit, by donating an asset, by making a trade-in, by making a drone. There are also other ways that can be categorized as way you can be disposing an asset. Asset disposal. Let us look at how we can draw this asset disposal, people. Which account will be affected when the asset has been disposed? These are the first account. These are the account that will be affected when the account is being. The first two accounts will be affected when the asset is being disposed. It's asset disposal and the asset that has been disposed. If the asset is in, remember I said to dispose an asset is when the asset is taken out from the books of the business. It's taken out from the book of the business. It's taken out from the business as well. That asset has been disposed. It's either by selling an asset, donating an asset, trading in. So, what are the first two accounts that will be affected if the asset has been disposed? Is asset disposal and then asset that has been disposed. If it's the vehicle, will be asset disposal and the vehicle. If we will dispose equipment, will be asset disposal and the equipment. Underline, people, or put that in mind. We always use the cost price because the assets are always valued at their original cost price. When we are doing these two accounts, double entry principle. The second two accounts that will be affected will be asset disposal and the accumulated depreciation. The second two accounts will be affected will be asset disposal and the accumulated depreciation of that asset. If it's equipment, it's accumulated depreciation of an equipment. If it is a vehicle, accumulated depreciation of the vehicle. So those are two double entry principles. Remember, people, as we're doing asset disposal, what controls us is a normal account. The normal account we're talking about in an asset that has been disposed. The normal account we're talking about the accumulated depreciation. The asset disposal account will be controlled by this normal account. Remember, the asset, if the asset has been disposed, the asset, the vehicle, for example, is an asset. It's increased on the debit side and decreased on the debit side. It's increased on the debit side and decreased on the credit side. So if the asset has been disposed, that means the asset will be decreased. Should the credit entry of the asset will be shown. Which means obvious. If the asset disposal will be debited by the asset that is disposed. If it's a vehicle, by the vehicle. And we are going to show you that on the example. And then the third two account that we affected will be asset disposal and how the asset has been disposed. Remember, I said the asset can be disposed by selling an asset, trading in an asset, donating an asset, making a drawings. There's also other examples. But these are mostly a effect that used to take place when it comes to disposing an asset. The fourth two accounts that will be affected when you are doing asset disposal will be an asset disposal and a profit and loss on sale of an asset. The account is profit and loss on sale of an asset, not profit and loss. It's profit and loss on sale of an asset. Those are the four accounts. Let us look at now how to draw this now in the general ledger. This is a vehicle. I said to you, the account that is, I want you to ensure that you take into consideration at most is the asset disposal. But we are also going to highlight other accounts because look, there will be a double entry principle. I will start with the first two accounts that is affected. Let's say the vehicle. This is a vehicle. This is a vehicle account. We have an opening balance of 60,000, which means when we open, we had 60, the value of 60,000 assets that we have, which are vehicles. And then accumulated depreciation. This is a balance. It's a balance on the credit side. This one have a balance on the debit side because a vehicle increase on the debit side. This one is because it's an asset. This one is also an asset, but a special asset, a contra asset, a type of an asset that increase on the credit side. That is why the balance for that asset is shown on the credit side. These are both assets. We agreed asset increase on the debit side, but this one is a special one, the contra one. It is different than other asset because this one increase on the credit side and decrease on the debit side. But all other assets increase on the debit side and decrease on the credit side. Let's say the asset has been disposed now, which means if the asset has been taken out from the business, that means our asset will decrease. So that will reduce the asset that we have within the business. We dispose the asset that was costing us 15,000. Remember, if the asset has been disposed, you recorded the cost price of that asset that's been disposed. Why the asset is credited by asset disposal, 15,000? Because the asset that we bought with 15,000 is the one that's been taken out from the business. So that asset costed us 15,000 when we were purchasing that asset. So now we won't have 60,000 asset, the value of asset within the business. We are going to subtract that 15 because this one has been taken out. So the first two accounts affected of the asset that's been disposed, we said the asset disposal and an asset that's been disposed. Which asset that's been disposed is a vehicle. So double entry principle. The vehicle will be credited by asset disposal 15,000. Which means the asset disposal will be what? Will be debited by the vehicle 15,000. Debited by the vehicle 15,000. Remember, I said the first two accounts that we affected will be asset disposal and the asset that we dispose. We dispose of the vehicle. And then that is why the vehicle is credited by asset disposal and the asset disposal is debited by the vehicle. Now they are going to look at the second two accounts affected. We said the second two accounts that will be affected will be asset disposal and the accumulated depreciation of the asset that has been disposed. Remember, we know now which asset has been disposed. It's a vehicle. Let us look at the following two accounts to be affected now. The accumulated depreciation. The accumulated depreciation will be what, people? Will be debited by depreciation of an asset. Why it is debited by the depreciation of, credited by the depreciation of an asset? Because the asset has been disposed, depreciate. It loses its value. So remember, we have balance of depreciation of all our vehicle accumulated to 23,153, and it's also depreciated this year before it was disposed. This is a current depreciation. So this is a current depreciation. The assets also depreciated this year. So where it loses value. So it depreciated by 691. And then the double entry principle will be the depreciation and as well as the accumulated depreciation. Because that affects because the asset loses value. What is to depreciate, people? It's when the asset loses its value. When the asset loses its value, we say that asset depreciate. So in the current period, on the 30th, the asset depreciated because this is not our balance, which means this one was for the previous period. In the new period, asset depreciated. So this one is for the asset that remain within the business. Remember, this depreciation is for that asset that is within the business. It's not for this asset that has been disposed. Because remember, each and every year, asset loses its value. So you must also remember, this 691 is for depreciation for this period where the asset that remains within the business also depreciated. So now I'm going to look at the one for that asset that's been disposed. This 6,480 is for that asset that has been disposed. Remember, I said to you, accumulated depreciation is an asset, but a special asset, a type of an asset that increase on the debit side and decrease, on the credit side and decrease on the debit side. So now it decreases on the debit side. What decreases this accumulated depreciation is an asset disposal. Because this asset now has been taken out from the business. It cannot accumulate the way our asset depreciated because it's no longer with us. So our depreciation now, it must be disposed, it must be subtracted by this amount. Our accumulated depreciation must be subtracted by this amount because this asset now no longer belongs to this business. So what made this 6,480 is the old accumulated depreciation for this asset that's been disposed and the new depreciation of this asset that's been disposed. The new one will be calculated based on the number of months the asset is within the business before it was disposed. If the asset was disposed, maybe, let's say the beginning of the accounting period is March, and the asset is disposed in June. So that means the depreciation for this current period, it must be calculated in month where the asset is been within the business. Where we say we are going to calculate this month, we say March, April, May, June, which means the business is within us for only about 4 months. If it's the end of June, it's 30th June. It's for 4 months. If it was at the beginning of the accounting period, it's March. So when we are calculating it, we are going to say the asset times the rate percentage, if it's 25%, times 4/12. And then you add with the old one, and then you get this one. I'm going to show you that one as well. I'm going to show you when we are doing the following activity as well. And the double entry principle, the accumulated depreciation will be debited by asset disposal, and the asset disposal will be credited by accumulated depreciation on vehicle 6,408. This is the format. I'm just showing you the format. So these are the second two accounts that will be affected when the asset has been disposed. That affects the asset disposal. The first one is the vehicle amount. The second one is the accumulated depreciation of that vehicle disposed amount. The third two accounts will be affected with how the asset has been disposed and the asset disposal. How this asset was disposed, people. It was taken by the insurance company. Which means the way it was disposed, it was taken by the insurance company. It can happen that we had an accident. One of our drivers had an accident, and then the car was the insurance write off the car, and then it was disposed by written off by the insurance took the car. So that's how it was disposed, this one, on this example. Because remember, I said to dispose an asset is when the asset has been taken out from the business. There are different ways where the asset can be taken out. It can be taken out by selling an asset, by making a drawings where the owner took the asset for personal use. This one was taken by the insurance company because the car was written off. So that is why on the credit side of a asset disposal, there is insurance company 8,000. So which means a insurance expense will be debited by 8,000 asset disposal if you are required to draw an insurance account. So that's how the two account will be recorded under asset disposal. Remember, I said to you, this is the main account. This is an account that I want to give it clarity to you. Because we've done this in grade 11. Just because now we are in grade 12, it does not mean that we must give you clarity on how to draw this account as well. So the fourth two account that we affected is that, is this asset disposed at a profit or loss? Is a profit on sale or a loss on sale of an asset and the asset disposal? So this asset was disposed at a loss. That is why there's a loss on sale of an asset. Remember, I said if this asset was sold at a loss, there's a loss on sale. There's a loss on sale of an asset. So that is why it must be adjusted on the credit side. Because I said to you, if it's adjusted on the credit side, that means a loss. If it's adjusted on the debit side, that means it's a profit. And then that's how you draw an asset disposal account, which means the double entry principle. If the asset disposal is credited by a loss on sale of an asset, 520, that means the profit or loss on sale of an asset would be debited by asset disposal, 520. That's how you draw the asset disposal account. And then you close off this account. We close off all this account. Asset disposal. This involves removing asset from the accounting record, balance sheet. Asset disposal. Remember, people, I said to you, what is to dispose? To dispose an asset is where you remove an asset from the accounting record, which is balance sheet. It's taken out from the book of the business because that asset is no longer within us, within the business. Depreciation, people. Let's also look at depreciation. There is an on-cost method. There's also a diminishing balance method. These are methods that are used here in high school. In universities, you are going to get other methods such as sum of a digit method. Those are the methods that are used there. But in high school, you use this one, a cost method, a diminishing balance method. A cost method is also known as a straight line method. If you are using this method, depreciation is calculated on the cost price. But the diminishing balance method, depreciation is calculated on the carrying value. If the new depreciation will make accumulated depreciation more than the cost price, do not calculate it. Remember, here we are talking about how to calculate the depreciation. You must also note this. If the new depreciation will make the accumulated depreciation, remember when the asset depreciate, each and every year, it's going to, the value of the depreciation going to accumulate. When we add the previous year with the current year, that will accumulate the way our asset depreciate. So now you must also note that if the new depreciation of an asset will make the accumulated depreciation be more than the cost price, do not calculate it, but just subtract the R1 on your carrying value, and then that will be your new depreciation. You must always remember that according to the GAAP principle, if the asset is depreciated in such a way that it will be, each cost price will be, the accumulated depreciation of that asset will be more than the cost price, the carrying value of that asset, it must be R1. It must be valued at R1. Because now it depreciated until it gets a negative price. So it must be valued according to the GAAP principle, that asset must be valued at R1. So when it comes to depreciation, do not bother yourself by calculating an asset, the depreciation of an asset. If you see, once you have calculated, if you add that amount, the money of the accumulated depreciation will be more than the cost price. Do not calculate it. Just take the carrying value of that asset minus R1. That amount that you are going to get will be your new depreciation. This is an activity that you are going to do under a tangible asset, under asset disposal. There's an old printer equipment bought for 120,000 and then was sold for 80,400, and then cash. On the 31st of August 2019, accumulated depreciation of this printer was 38,400. On the 1st of March 2019, depreciation on this equipment is written off at 20% per annum. According to the diminishing balance method, prepare the following account: equipment account, accumulated depreciation on equipment, and asset disposal in respect of equipment sold on the 31st of August 2019. This is your activity.